let's talk about what's going on with the equity markets. On the equity market side, the basic question is, are we going to see as strong earnings growth as is currently priced in? Remember, the expectations, bottoms up, analyst expectations are 12% earnings growth over the next year, over 24 and 25. So let's talk about how earnings growth has actually played out. Remember, if we go back to what's been going on here, nominal GDP growth in the economy over the last year has been above 6%. In the last quarter, it was measured to be 8%. That is a very strong nominal growth in the economy, right? How are earnings doing? Not well in comparison. And I think that's an important thing to recognize. That is the tightness in many cases that reflects the fact that the corporate environment, the large company environment, just isn't succeeding anywhere near as strongly as the overall economy. And certainly the earnings growth that we're seeing is nothing close to what is being seen in terms of overall GDP growth. And so we can see that in the chart here. We've had, really earnings growth has been flat for the last 2 years. Now, remember, nominal GDP growth has been running at 6% for the last 2 years. Earnings growth has been close to flat. All right. Given how good the environment was over the last couple of years in terms of nominal GDP growth, if earnings can't deliver consistent quarter over quarter growth during a period of extraordinarily strong nominal GDP growth, how the heck are they going to grow 13 or 12% each year in 24 and 25 when almost certainly growth will be weaker in the future than it has been in the past, given the tightening that's occurred in the economy? And I think that's a really critical discontinuity that exists between the expectations that exist in the equity market relative to the macroeconomic realities on the ground in terms of growth. So what are we seeing? Basically earnings growth that's been flat for the S&P 500 and expected to continue to be flat and maybe start to, the boom in earnings is always coming, but it's coming, 6 or 9 months away when the macroeconomic reality is further tightening. So we see weak earnings, reported earnings. We see sales beats that are basically the lowest that they've been in years. And we see, I think we see over here on the bottom right-hand chart, a lot of companies with negative guidance overall through the course of the earnings season. And I think probably actually one of the more interesting things that's going on is we see a fragility in the equity market. And that fragility, I know for those of you who traded the last 10 days, and it seems like stocks only go up. I think under the hood, it's really interesting to see how those companies who have come in with underperforming earnings, how they've performed in response. That's what this chart here on the upper right shows. And it basically shows that the negative earnings surprise companies have underperformed or have fallen the most of any time over the course of the last 5 years or so. And what that really highlights is the fact that when it comes to the equity market, what we have is very elevated expectations, earnings that are kind of mediocre in comparison to those very elevated expectations, and fragility that any time that you see companies fail to reach the extreme expectations that are in the market, they're falling they're falling significantly relative to history. And so that is the combination of dynamics that could easily set up for a meaningful disappointment in the market as we turn to 2024 and the expectations that are built in there.